So please welcome the Olympic man himself, Lord Deighton, who was, of course, head of Locock and is now Commercial Secretary to the Treasury. Lord Deighton.
Well, thank you, Fiona. I tell you, when it comes to being on time and on budget, there's nothing quite like having your reigning monarch scheduled to parachute into your opening ceremony with the whole world watching. So if anybody needs any incentive to get their projects finished on time, that'll do it. We've got half an hour to discuss infrastructure with you and infrastructure finance. I hope you've got the message so far that it's one of the most important things we're focused on here in the UK. Infrastructure is not boring other than with the relentless long-term reliability of the returns on your investment in it. That's the only boring part of it. I've got a star-studded panel. Let me introduce them to you. Nearest to me, we've got Andy Hunter, who's an executive director in Cheung, one of probably the biggest inward investor in the UK, specifically in the regulated utility sector. So he's got a lot of experience here. We've got Neil Petroff, who's the chief investment officer from Teachers, one of the biggest and most influential pension funds in the world, about $130 billion. So are we getting our fair share is the question to him. And on the far left there, we have Hiroshi Watanabe, who is the chief executive of JTIB, the Japanese overseas investment bank. They, for example, have been big supporters of the UK, recently financing our rolling stock into the Intercity Express train line. So all with very valid experience here in the UK, but also with a very broad understanding of what the widespread opportunities are in the infrastructure marketplace around the world, the one in which we in the UK are effectively competing for funds. I mean, let me set the scene before I ask each of these guys to give 3 or 4 minutes, and then we'll open the floor up to questions. There is clearly a massive requirement around the world for infrastructure, whether it's ports, roads, airports, railroads, power generation or networks, water systems, waste systems, the digital infrastructure, upon which all our communications are based. And we're all focused on delivering those effectively. They're important because they are the foundation upon which our competitive businesses have to be plugged into play. They're also, of course, the key industries to provide vital services to our people. And last but not least, particularly in this economic environment, during their construction phase, they're an incredible stimulus to jobs and growth. All those things are the reason why infrastructure is now sexy and right at the top of our list of priorities, as you've heard from so many of the speakers this morning. Here in the UK, we're very focused on it. You've heard we've got a national infrastructure plan, over £300 billion, particularly focused on energy and transport. There's already a lot going on. Ed mentioned that we haven't done this much since Victorian times. In fact, in the railway, for example, where we've got Europe's biggest construction program going on underneath us at the moment as we're tunneling through Crossrail. We've also got HS2 getting underway in terms of the planning process, but the biggest investment in our railways since the 19th century. So there's already a lot going on, but a focus going forward. And of that £300 billion, we expect something like 3/4 of it to be financed from the public sector. We're doing a lot to help that happen. Again, you've heard about our history in getting the private sector involved in our important businesses, our pioneering history back to privatization, public-private partnerships. We've been pioneers in all these areas and have exported them to other parts of the world. And now I think with infrastructure, we're trying to be as innovative again, partly through our UK guarantee schemes, £40 billion to help get these infrastructure schemes invested, our Green Investment Bank, £3 billion of capital available there, and a number of other things we're happy to do. Frankly, the policy we're putting in place, Ed talked about our energy bill, making sure that that regime is translatable into financeable contracts so the sponsors of energy projects can build in the certainty that they've got a take-out contract that works. That's where the demand for infrastructure is. Capital clearly has an appetite for long-term, stable inflation-linked returns, which is what infrastructure can offer. So I think the question in front of the panel, we know what the requirement is, we know the capital's hungry for those kinds of returns. What do we need to ensure we channel that capital into these opportunities and that here in the UK we get more than our fair share? Because as Neil told me earlier, if you add up the requirement around the world for infrastructure, the amount of capital it needs just about adds up to all the capital in the world. So this is a highly competitive business if you want your fair share of that capital. So with that introduction, Neil, can I ask you to give us 3 or 4 minutes in your comments?
Sure. Thank you very much. Most pension funds and sovereign wealth funds basically over the years have invested in brownfield investments because they're predictable, stable, long-term assets that pension funds really like. But why do we invest in brownfield? Because most of the investment staff and analysts around the world don't have an operating background. They really have a financial background, which means that they look at historical results, 10 years or 15 years, they extrapolate it, they put in a lot of assumptions, discount those cash flows, and at the end of the day, they come up with a judgment on the expected return for those cash flows. On the other side of the spectrum are the needs of the government. And the governments really are looking at greenfield investments, which are which are new to the pension funds and sovereign wealth funds investment toolbox. In fact, you don't have any cash flows. Everything is a projection or a speculation on what the earnings, what the costs will be. And they're long-term big assets that really a pension fund as an investor doesn't really have a construction leg or someone that they can depend on to build these massive infrastructures. So I think there's a huge gap between what pension funds and sovereign wealth funds have invested in the past and what the government requirements are. First thing is, I think everyone knows this in the conference, and there's been, all the talks about it. But I'm trying to figure out what's a possible solution to this impasse between brownfield and greenfield. And I think the government has done the first step to develop an operating model to deal with the greenfield risk. Debt financing, I think, is very important, guaranteed by the government. Take-or-pay contracts, the ability to syndicate some of these very large assets to find like-minded investors. So at the end of the day, all of that is really saying, how can the government move halfway towards brownfield, and investors in brownfield move halfway towards greenfield. And that is, I think, the challenge of the government and the investors coming together. And I thought about, how would I go about doing this? And it's really to develop a long-term life cycle of investments. So I can envision where you find an infrastructure project that has some guarantees from the government, that have take-or-pay contracts. So now the returns become a little bit more predictable. Therefore, you can model some of those more predictable cash flows. And then the pension fund would earn what's very important for us, the required rate of return on the risk we're taking, which is clearly more risk than a brownfield. And then after the government and the investor get together and actually make the investment, the investor holds it for 15 years or maybe longer. And at the end of the day, what happens is after 15 years, it goes back to the government. The government puts now a brownfield asset up for auction, and the returns by most of the investors around the world are lower than greenfield, and therefore the valuation would be higher, so the government would actually earn a return on that investment, eliminate their government guarantees because the brownfield will have financing available to it, and then ship this investment back to the private sector. So in short, it's really develop, operate, sell, and reinvest. And the only caveat I would say is you don't do that with 200 projects. You don't do that with 40 projects. You just start with one, and in 10 years' time, you'll be able to recycle that. So it's an ongoing recycling of the capital that you're acquiring in the UK. And that's basically my 3 or 4 minutes presentation.
Thanks,
of what
Neil.
my thoughts are.
Neil's raised, the issue that we all come up against, which is, we certainly find that here, that when we're in the business of selling an existing operating asset, the competition amongst the providers of capital is intense because these are attractive assets. When we're trying to build a new piece of infrastructure, we have to be highly creative, and the government has to take a much bigger risk share to get it off the ground. And is there a way of bringing the two together so we can create a whole life cycle? I mean, the question I'd have for you, Neil, if we shift to other assets you've invested in, let's say real estate, my sense is that the institutional market over time has been comfortable with taking development, construction risk in the case of the real estate market. Yeah. Can you see the institutional market beginning to get comfortable with some of the development and construction risk in some of the infrastructure assets, and how are you going to get there, and which ones are likely to be at the front of the queue that you could get some comfort with?
Well, I would say that as a pension fund, we're opportunistic. So we will look for infrastructure globally, which we have done, and we always think of the risk for 300,000 teachers. And what I would say I would describe ourselves are risk managers, where the byproduct is returns. But we've invested in the UK. We have a UK office here that looks for private investments, and they also look for infrastructure. We own 2 airports, Birmingham Airport and Bristol. We own Scotia Gas with Borealis. We own High Speed 1.
We've got another one coming along soon.
Yeah, High Speed 2. But that's we'll wait for to see what the costs are when it's sold for the second time. And we also own Camelot, which is the UK National Lottery. So all of these things were done at an opportunistic basis with a great return. We like the UK economy. We like the government regulatory regime. We like the property rights. We like a lot of things in the UK. But
I should stop you there. I like.
I mean, and that's why we've invested over £4 billion in infrastructure here. Not as big as you, but still it's a start. But let me say that infrastructure at Ontario Teachers is one of many asset classes. So it currently represents 12% of our portfolio, 13 billion. But over time, we plan that to grow it, but we don't plan to grow it in the hundreds of billions that are required.
Thank you. Well, you like the UK. We know Andy likes the UK because he's got a lot of investments here already. But Andy, what have you got to tell us about infrastructure investment?
Well, thank you for that introduction. It's a great pleasure to be here this morning and to say a few words about infrastructure investment in the UK through the eyes of a foreign investor. I appreciate I may not sound very foreign, but but I work for a large Hong Kong-based public company. I've lived in Hong Kong for 30 years. Cheung Infrastructure invests in and manages low-risk, low-return businesses offering stable and predictable long-term returns. We've invested variously in electricity distribution networks, gas distribution networks, water utilities, and contracted electricity generation here in the UK, but also in Australia, New Zealand, and Canada. Why do we invest in these businesses? The simple answer is risk management. The larger Cheung group, of which CKI is a part, is engaged in many cyclical businesses: property development, oil and gas exploration, container terminals, mobile communications, retail, and across many countries. Regulated utilities, if well managed, are, as I say, low-risk, low-return businesses and are complementary to the risk profile of our group as a whole. So CKI invest in dull, boring, predictable businesses which are regulated in a dull, boring, and predictable way. And even talking about it sounds rather dull, boring, and predictable. So for that, I apologize, and I'll be brief. We've invested significantly in the UK this last few years. In 2010, we acquired the regulated electricity distribution networks for London, the southeast and east of England. In 2011, we acquired Northumbrian Water, one of the country's 10 regulated water and sewage companies. And in 2012, we acquired the regulated gas distribution business covering Wales and the southwest of England. The combined value of these recent acquisitions exceeds £12 billion. What attracts us to regulated networks in the UK? Well, the simple answer is stable regulation. The UK has led the world for many years now in providing stable regulation. And as the regulation evolves, as it invariably does, changes have been made, in our view, in a sort of sensible and reasonable way, with the fundamental goalposts of the regulation never really changing. So while a number of factors, such as the rule of law, the openness of foreign investment, the sophisticated and well-developed capital markets, the low level of political risk, they all play a part in our investment decisions. The stable regulation, I've got to say, is key. As for the challenges for infrastructure investment over the next number of years, as I mentioned, while we're a large investor in the UK, we're quite a narrow investor in the UK. Social infrastructure, transport infrastructure, merchant power generation, that's the preserve of others. We concentrate on regulated network infrastructure. And over the next 5 years, significant investment is required in our aging networks. I can only but echo the earlier comments of the Secretary of State. We not only need to maintain our networks, we need to modernize them. And these improvements do not come cheap. We already invest across our regulated businesses in the UK about £1 billion annually, and this number is only set to increase. The challenge then is whether the regulation will continue to incentivize these investments. Now, we Brits, we like to have a moan. It's very easy to criticize regulators and regulation, but I've got to say, as a foreign investor from the outside looking in, we have to admit that on balance, the regulation works. It's certainly not perfect, and I'm certainly not suggesting we always get away with the regulators. I wish we did, but we're the first to admit it does work. For example, our gas distribution businesses have just been through their regulatory review, which fixes their operating environment for the next 8 years. Now, while the regulator has set us very challenging operational and financial targets, we as owners of these businesses know that if our management teams achieve these targets, then we know the returns we'll make. Another cautionary thought: during austere times, it's got to be said, in various parts of the world, politics can get in the way of good regulation. Overriding regulators and imposing price cuts or charging windfall taxes, such like, may well give rise to short-term political benefits, but I've got to say they also act as a very significant deterrent to foreign investment. Our view when we invested in the UK that this was very low risk, and I'm confident this will not prove to have been misguided. So to sum up, we're a very large investor in the regulated electricity, gas and water sector in the UK, and we'll continue to make the very significant investments that are required annually by our businesses for as long as the regulation continues to give rise to stable and predictable returns.
Thanks, Andy. I mean, you raised and described very clearly just how important in this industry the regulator is from the investor's point of view. You're relying on them to, you know, conduct a market regime which works both for you and the consumers. I mean, so I just want to explore that a little bit more, because, you know, if you're looking at the regulator from the outside and the pressures on the regulator, it's all about keeping prices down for the consumer. That's where the politics in this really is. That's where the votes are. Why is it that you're comfortable that the regulatory regimes you're involved with get the balance right and they're not constantly squeezing your returns because you know, goodwill is in keeping prices low?
Sure. I'd say the comfort and the confidence has come from observing the regulation over the longer term. Yeah, certainly there's tariff pressure, there's tariff concern, but I actually have come to think that the regulator gets it in the neck more if reliability and customer service and health and safety is compromised. And the constant issue for the regulator is to balance tariff concerns with reliability, customer service, health and safety. And over the longer term, I think Ofgem and Ofwat have tended to strike a very sensible balance.
I mean, you're in the business of allocating your group's assets around the world to get the right mix of returns. How does that, give us some insight as to how that process works and what, you know, the case you have to make to get a bigger share into this market, for example?
Sure. As I said earlier, we're trying to balance business risk across a group which has a lot of activities in a lot of countries. Low-risk regulated return businesses are very much part of our philosophy. Where do we want to invest in low-risk, low-return businesses? Where the regulation gives us certainty that that will be the case. It really is, as Britain, it's no surprise, no shock that we're large investors in the UK and Australia. I don't think the Australians would feel offended if I was to say all they've done is copy British regulation, because in essence, with regards to electricity, gas businesses, that's exactly what we've done. So we treasure the regulation. It plays a large part in our capital allocation process sitting back in Hong Kong. The fact that it's for the long term. You invest in a network, the network assets through the regulation get depreciated over 40 to 50 years. It's very important as investors you have confidence, perhaps not for the whole 40 to 50 years, but for a reasonably long period of time, that if you make the investments, if you operate the businesses in an efficient way and hit the regulator's requirements for reliability and customer service and safety and all, a whole list of non-financial targets, then you will earn the regulated return. And confidence in that regime is hugely important when we sit and decide where we want to deploy capital in regulated utilities.
Okay. Thank you, Andy. Now let's switch to the view from Japan. Japan, of course, your businesses, your industries are big players in the provision of equipment into the infrastructure world. So I'm sure that'll be part of your comments. Hiroshi, over to you.
Okay. Well, thank you, Lord Deighton. And before answering to your question, I'm very happy to hear the UK maintained a very good economic performance even after the Olympic Games. Most of the Asian countries has faced a severe difficulty in the 1 year later on that. So that was the experience. Maybe one of the reasons is too much government intervention to channel the infrastructure long money into the specific sector, like the gymnastic facilities or the transportation connecting to the site. So such kind of misallocation has caused such kind of very bad situation in the economy. So in that sense, even in UK and the other countries, somewhat the program and the balance, the allocation of the fund is quite important to that. So in that sense, I think the UK has maintained a very good policy. at this moment to that. And also, just after the Beijing Olympic Game, we have very much the volatile capital market condition in the global side on that, Lehman shock and the euro incident or like that. So recently, we have the world of the financing to that. Now, short-term money is almost abundant, or almost flooded into the many areas. But the long-term money, which is necessary to the infrastructure investment, is very scarce to that. So our financing side, we are going to make some effort to make the short-term money into the long-term money by offering some kind of assurance or guarantee to join, or attracting new members to come into such kind of syndicate. That is one side on that. But also, the hosting side is also make some effort to that. So in that case, I think the competition is getting much, much harsher. Recently, OECD has estimated in coming 1 decade, we need a 20 trillion US dollars operation throughout the world to that. And also similar estimate is done by the Asian Development Bank. So for the coming 1 decade, they need 8 trillion. So the other estimates has another 5 trillion for the Latin America and Africa and even the Central Asia to that. So that means the 7 trillion is needed in the developed economies. So now we have kind of a trade-off on the new construction of the infrastructure in the emerging and the developed economies. On the other side is the maintenance, repair, and renovation in the developed economies, which is more attractive and which is most offering the higher return. It's quite important to that. So of course, not only the nominal return is working, somewhat the stability and the predictability and the reliability is important. So in that case, I think the developed economy has some kind of advantage to that. But if the government makes a very big size of the intervention, even the brownfield doesn't give such kind of assurances. If the government makes the big size of the subsidy, for example, in the case of energy sector, of the feed-in tariff for the renewables, if the government is going to face austerity, they have to cut down such kind of expenditure. That has a big change on the future calculation to that. And also, if the government is going to make some kind of the intervention, and as you mentioned about the pricing, so in that case, even the brownfield is not much so reliable to that. So in that case, the new investment is just floating around which way they are going to that. That is very much different situation there. But as far as our bank, the Japan Bank for International Cooperation, has very long discussion with our sponsors and also the constructors and also the manager and operator of the infrastructure. So they found the UK current investment environment is quite the attractive to that. So in that sense, as I said, the reliable and also the predictable. And also there is no big populistic movement for the dumping the pricing. And also the foreign exchange, the situation is not so bad. Some years ago it was so bad to that, but now we count on the inflation rate and also the foreign exchange market. Still they can have some kind of good assurance to that. And also different from the emerging economies. In the case of UK, we can use a local currency, starting pound to use to that. Most of the Asian economy or even Latin American economy, they have to bring in the dollar and the euro to be converted into local currency. The revenue is in the local currency. So if there is such kind of the good adjustment of the pricing or the foreign exchange market, it has big negative impact for the operation. But in the case of UK, as far as sterling pound is somewhat healthy, so in that case, they can have some good operation. So in that case, recently, we have the finance of the Japanese company's operation here in the transportation, the renovation of the new the railway, and also now they're going to have some purchases of the energy company to that. So I think that is a reflection of the sponsors and operators' confidence in your country. And we highly appreciate such kind of operation to that. This is the current observation for the JB to the UK economy to that.
And I mean, really to follow up on Neil's point, the brownfield, greenfield, how critical is the role of the equipment suppliers, which effectively can be the sponsors to these projects, in absorbing those risks which the pure financial investors are reluctant to absorb? Is that the key to progress here?
Yeah, I think, of course, the reality is somewhat different, but hypothetically, the big size of the sponsor or investor can have taken some risk on that. So they can have some of the mobilization money into the greenfield. But if most of the small and medium size of the investor is going to have somewhat cautious operation, in that case, they are going to have even though the lower rate of return, but the more the predictability and also the reliance. So in that case, they prefer to have the brownfield. So hypothetically, the rate of return of the greenfield is higher than the brownfield on that. So such kind of allocation or the division of labor should work to that. But in some countries, sometimes the government intervention is too huge, or the repercussion of the political party is going to have some kind of the skewed situation. It causes some kind of the not good working of such kind of good cycle to that. So in that case, money is just floating. So in that case, there is no good operation on the infrastructure.
Thank you. Well, look, we've got about 10 minutes left. I'd like to throw the floor open to questions. We've got one over there.
Thank you. Thank you, Lord Deighton. Mark Fallon with CH2M Hill. We, along with our consortium partners, were part of the ODA's delivery partner on the London 2012 Olympics. And among the many sort of factors that contributed to that success were the accountabilities and authorities of the delivery partner were quite clear to us. We've discussed some of the complexities your panel has related to greenfield financing. I'd be curious to know what the panel thinks of the appropriate role for project and program delivery firms and contractors to make those programs and projects successful.
Okay. And is that one? I think that's probably one for you, isn't it?
Not really, I've got to say. We've got very limited experience of greenfield investment because we're a regulated network business. The one experience we have of greenfield investment reasonably recently, we were part of a consortium that built a power station, 1,400 megawatt power station in Thailand. As I'd outlined earlier, we're rather dull, boring, predictable people, and the only way to make a greenfield power plant construction hit our risk hurdles was, first of all, to sign up an EPC contract with a very well-respected equipment manufacturer, and for the Thai government to sign a 25-year offtake agreement for the entire 1,400 megawatts of the power plant. So that combination of laying off the risk with a manufacturer and having the comfort of a rock-solid off-taker over the estimated useful life of the asset was a combination that got us investing in greenfield sites. But that's a rarity for Cheung infrastructure.
I mean, let me answer on behalf of the sort of the UK government, the ultimate client. I think we did a lot of work on our comparable performance in terms of delivering projects in this country versus other countries. It's absolutely clear that the critical time in any project where you can save money, get it all sorted out, is before you start. And that's precisely where the kind of design, planning, programming expertise that Mark's talking about comes in. So that's the end of the official advertisement, but absolutely, we understand that's where the value's added, and frankly, where all your opportunities to do these things better really exist, right at that front end period in planning the project. Other questions? Sean.
Hi, Sean Kingsbury from the Green Investment Bank. We heard earlier about the scale of the capital required to move the UK towards a more sustainable economy, about £110 billion. What can the UK do to secure more of that foreign investment?
Just the green, it's this thing, how do we attract green investment?
Well, I mean, from us, from teachers' point of view, we're looking at all opportunities, whether it's green or brown or whatever, and some of the green investments in Canada, for example, are highly supported by the government to make them attractive, when the government changes the regulation, they become highly unattractive. So it goes back to Andy's statement that you need long-term predictable regulation and to make it work, because those green investments are forever and the governments are not. And you got to make sure that as the governments turn over, different politics come in, maybe a tax regime comes in, maybe a regulator comes in. So to attract that, we need something more predictable, whether it's green or brown.
I think that's what I mean. And when we heard from Ed Davey, the Secretary of State for Energy, that's precisely the intent of the energy bill, is to provide that kind of comfort, whether it's through contracts for differences to commit long-term prices, or by the way in which we will grandfather in historical commitments into future agreements to provide precisely that kind of support to allow us to transform our energy mix into one which is hits our renewable targets. And of course, Sean, who asked the question, is from our Green Investment Bank, and he's there to invest alongside industry to help them into some of those projects which may be at the margin of happening, and he'll come along with some capital and get them over the line.
May I? Yes.
Please,
so
yes, Hiroshi.
Not directly the answer to your question to that, but I think even for the greenfield, I think no one can take too much risk on that. Especially in the case of the infrastructure, most of the business in the network or the grid throughout the nations. So I think the public contribution or government contribution is quite important. So if they set a very proper, the long-term arrangement or the design for the making the infrastructure, in that case, even the greenfield investor can have some kind of the confidence to come to that. So in that sense, I think the UK is doing fine on that. Some good coordination between the central government and the local government. In some emerging economies, the decentralization is politically good sense on that. But sometimes making the nationwide grid or network, it doesn't work to that. It makes some kind of confusion and chaos to that. So recently, JBIC is going to ask most of the Asian economies to have such kind of making grand design in collaboration between central government and local government. As such kind of the good showing on the idea is very much the sustaining the effort for the foreign investors to come to that. That's my feeling of that. Yeah.
Thank you. I think we had another question here. You okay? Here's the microphone.
I'm Prakash Hinduja from the Hinduja Group of Companies. I'm the chairman of the Hinduja Group of Companies in Europe. I'm very impressed with the panel which they mentioned about the infrastructure plan. But we'd like to question a panel that the survey, if you can plan, how did China infrastructure went through? That's one. Second thing is, India today needs $1 trillion for infrastructure. If you see the success of UAE and Abu Dhabi, the infrastructure took place over there. Who were behind them? They were British, were the key people, according to my analysis, who played a very important role with the European together. Now, if you want the British to have a foreign investments from Indian people who are well-to-do and staying in United Kingdom for so many years, they can come in a big way, provided we can get an Indian skill power, which can bring down the cost. Take, for example, recently they had a US, Britain, and India. They signed a tri-party plan for infrastructure. Only yesterday there was a meeting in India where Japan is today supporting India in a big way in a long-term financing for corridor and infrastructure programs in a big way. Similarly, in UK, if you want to bring more foreign investments, we should have a consortium of all the major infrastructure companies. And a government, as we mentioned, the joint pension funds will be more attractive. Ontario teachers are only one company, but there are so many other pension funds like State Street Bank of, and so many other pension funds can come in UK in a big way. And I'm positive UK played a very important role 200 years ago, built the infrastructure in India, which we are still continuing the same way. So we should have a strategic plan by the government to work out in a plan in such a way that how the past track record has been structured in last 10 years or 1 decade or 2 decades. And you will have a huge infrastructure plans can come in a big way from the consortium which can be structured. Then the financial institutions, banks, foreign investors, and the private sector by creating a product, a financial product which should be backed by the government, and then it will work out. This is the best solution which I think it can be done. If the panel can able to give views on that, I'll appreciate very much. Thank you.
Well, thank you. Last week I was in India and I discussed the planning committee people and also the Ministry of Finance people to discuss on the issues to that. So I agree on that. In the case of India, now they accepted the shortage of the infrastructure. So how to promote is quite important for the future to that. So as I said, how to coordinate the central government and the local government. So the JBIC has already made the equity participation to the Delhi-Mumbai Industrial Corridor Development Company to that. So now we are making to contribute the designing at least 6 states combining the Delhi and the Mumbai. Such kind of operation is working. And also even other area in the southern part of the Chennai and also from the Mumbai to the other cities. So such kind of the rather two-dimensional planning is already started. So I think it could have some good payment for the inviting foreign investors to come. So, but still I think the coordination between or among states is somewhat causing some kind of trouble and there is very slow movement on that. And also in the case of India, I think the protection of the property rights is rather too tough to that. So it's very tedious time to go on to the situation on that. But I think this is one way to that. The China is very much in contrast. In the case of the property right is the very big different type of operation. And also still the most of the operation in the infrastructure done by the public corporation or the government itself to that. So they are financing directly from the foreign capital market or even for getting the concession loan. Then they use in the specific the allocation of funding to that. So anyway, now in combining the 2.5 billion population is working hard to make the more good infrastructure. But now we observe the big two different operations. So far they are doing very well to that. But I think in coming cases, we need some kind of the narrowing such kind of the difference of the operation is quite important to attract more foreign investors, have the good predictability for the future to that. That's my sense of it.
Okay, now look, thank you for that. Look, we're out of time now. I know we're the only thing standing between you and Boris, which is a spectacle I want to make sure you can enjoy in its full glory. Thank you to the members of the panel, and thank you to all of you for your participation. Thanks very much. Thank you. Thanks, guys. And we'll go. Thank you.